runs out.
What's fascinating here is that this frictionless nothingness, right? Like the absolute absence of barriers, fees, or second thoughts for the consumer. That's always been UPI's biggest feature.
Yeah.
But as we look under the hood of the financial reporting, that exact same feature is now the greatest existential threat to the entire network.
Wow, an existential threat.
Yeah, because whenever you're using a digital service that feels completely free, someone, somewhere is paying for the infrastructure. I mean, for a long time, the sheer scale and convenience of UPI kind of masked the massive cost of that underlying tab.
Okay, let's unpack this.
Yeah.
Because we definitely have a tendency to view digital transactions as magic. You scan a code and money just teleports from your bank to the merchant's bank.
Right, teleportation without a cost.
Exactly. But let's look at the mechanics of what is actually happening in the background. Think of UPI like a digital highway. It feels totally free to drive on, but there are toll booths and maintenance crews that we just cannot see.
That's a good way to put it.
Or, imagine UPI as an impossibly fast postal service operating between two massive, incredibly complex libraries, those being the banks. Every time you buy a coffee, a postman, which is the National Payments Corporation of India, or NPCI, has to deliver a payment request from the merchant's library to your library.
Right.
Both libraries have to instantly locate your specific physical ledger, verify you have the funds, update the balance without a single error, and then send a confirmation back.
And doing that once or twice, that's easy, but doing it millions of times a minute changes the technological requirements completely.
Right, the scale is the issue.
Exactly. Traditional core banking systems, they were never built for this kind of traffic. I mean, historically, banks updated their ledgers in end-of-day batches.
So they weren't doing it in real time.
No, not at all. But with UPI, they are forced to process these microtransactions instantly. We're talking about latency windows measured in milliseconds.
That is insane.
It is. And to prevent the system from just crashing under that load, banks have to run what is called an active server architecture.
Active. What does that mean exactly?
So that means they aren't just running one massive data center. They are running multiple redundant server farms simultaneously, 204/7.
Just in case one goes down.
Exactly. Just to ensure that if one fails, your 50 rupee payment to the T vendor still goes through instantly. And maintaining that level of active hardware plus constant fraud checking, it costs billions of rupees.
Right. And in the traditional Visa or MasterCard ecosystem, that massive back-end cost is covered by MDR, right?
Yeah, MDR, or the merchant discount rate. That is essentially the oxygen that keeps traditional payment systems breathing.
Okay.
It isn't just a single arbitrary fee either. When a merchant swipes a credit card, the MDR they pay is split several ways.
Like who gets what?
Well, my portion goes to the acquiring bank, which is the merchant's bank that actually provided the point-of-sale machine.
Got it.
Then another portion, which is called the interchange fee, goes to the issuing bank. That's the bank that gave you your credit card. And a smaller slice goes to the network itself, like Visa or MasterCard, just for acting as the secure bridge.
So everyone gets a little piece of the pie.
Exactly. That split incentivizes everyone to keep their servers running and, their security tight.
But the Finshaw's article points out that in 2020, the Indian government completely banned banks from charging MDR on UPI transactions.
Yep. A total ban.
And this is where the logic seems a bit tangled to me, honestly, because the ban on fees was tied to an amendment in the Income Tax Act, where the government made it mandatory for any business earning over 50 crore rupees to offer digital payment options.
Right, the legal mandate.
Yeah. So if the government is already legally mandating adoption, why do they need to ban the fees? Wouldn't the legal mandate alone force the merchants to comply?
Well, a legal mandate looks great on paper, but behavioral economics dictates what actually happens on the ground.
Okay, fair.
If you force a business to adopt a new digital payment system, and that system costs them a percentage of their revenue every single time a customer uses it, they are going to react defensively.
Because their margins are already tight.
Exactly. Merchants operate on razor-thin margins sometimes. They would inevitably pass that new cost directly onto you, the consumer, by just raising prices.
Oh, I hate when that happens.
Right. Or they would introduce friction, like imposing a minimum purchase limit of 500 rupees for UPI transaction.
Right. You see that with cards sometimes. No cards under $10.
Exactly. In a worst-case scenario, the massive, unorganized retail sector would just find loopholes to quietly refuse compliance and push people back toward cash. which completely defeats the whole purpose of a digital India.
Ah, so they had to make it irresistible.
Precisely. To ensure absolute frictionless compliance, the government basically sucked the oxygen out of the room. They legally prevented the banks from charging the merchants, creating a zero MDR environment.
Which creates a massive vacuum, because those servers you mentioned, they are still humming. The redundant data centers are still drawing power. The engineers are still getting paid.
Oh, yeah. The bills still have to be paid.
Right. So if the merchants aren't paying the MDR and we, the users, aren't paying a convenience fee, who is actually covering the billions in operating costs?
Well, the government stepped in to fill that vacuum with taxpayer money.
That's subsidies.
Yeah. Knowing the banks couldn't just sustain a multi-billion-dollar public utility out of the goodness of their hearts, the government introduced an annual subsidy to cover the operational costs of both UPI and Rupee debit card transactions.
And that worked
For a short window, yeah. This held the ecosystem together.
until the scale of the system completely outran the budget.
Exactly.
I mean, the math here is genuinely staggering. To understand why this subsidy model broke, we really have to contextualize the sheer volume we were talking about here.
It's massive.
It is. In the financial year 2026, UPI